Steve, the stock market has, the S&P 500 has officially entered correction territory, or at least it had yesterday. It's actually up today, so I imagine it's back out of correction territory or official correction territory. But we've generally not talked that much on this show about market movements just lately, and it's been a pretty volatile time in the markets. We've talked a bit about individual stocks and where our portfolios have been going, but and measured them against some indices along the way. But we do get stock market corrections every so often. I think the last one was kind of as recently as last July, perhaps. But we thought it'd be a good idea to talk a bit about how we think about these things and how we approach them, and maybe how that's changed a bit over time, I guess.
Yeah, maybe just some quick tips on how we deal with corrections, really, and how we think about them. Because we've been noticing that obviously there's a lot of sort of panic around the communities and things like that, and there's people like, have I invested at the wrong time? Should I sell everything out and wait? And there's a lot of people out here for who statements like that is massive eye roll, but there's people out there who it isn't. So this is really for everybody, but also for the beginners out there, just to learn from a couple of people who have been through a few now, and what we do to deal with it. So I guess hot tip number one for me would be to stop looking. So if you feel like you're getting it's getting on top of you, and you check in 5, 6, 7 times a day, and you're seeing red numbers that you don't like, and it feels you feel like you're out of control, the answer would be to stop looking. And the best thing you can do is to delete your app, focus on something else, get yourself a better hobby than checking stocks. So I do things like I read, I bake, I torment people on Reddit, but anything other than checking, because checking doesn't help. There's a famous saying in the stock market, I think it was Buffett, but it might be Lynch, but stocks don't know you own them. I'm fairly certain it's Lynch that. Stocks don't know you own them. They don't need you to check on them. They don't go, like Barry hasn't checked on me this week, and he doesn't know that I'm down 3%. That is really irrelevant to stocks. And like I say, all checking does, especially when you have no intention to do anything, is just make you feel worse about your portfolio, especially when there's all this negative news already. So if you've got really no money in the portfolio and there's nothing for you to do, stop looking, Steve.
Yeah, if you're in it for the long term, then you're probably going to have to sit through some or other correction on the way. What matters is where you start and where you finish. Buffett did say something like this. I don't know whether the quote you have in mind is Buffett or Lynch, but I believe it was Buffett who said, if you watch every tick, you're going to invest like a dick. No, it wasn't him that said that. It was someone else who said that. But that's also true, and kind of out of that mindset from Buffett. You're right. I think having stuff to do that's nothing to do with investing is pretty helpful. Relatedly, I think the way I think about, or the way I feel during these kind of downturns, has changed a bit over the last however many years it's been since I started investing. And there are two reasons for that. One I'll come back to in a moment. But one of the things that I find immensely helpful in this is doing things like this show, to be honest, talking to people about what's going on, talking to people about what I'm thinking and what I'm doing, and having to sort of say things that are going to have to sound halfway plausible, either just to Steve or to this camera that I'm currently speaking to, I find helps me quite a lot, because I know that if I do something, we both know deep down that getting shaken out of the stock market is a sign that something has gone wrong. Either you invested when you shouldn't have in the first place, and you need the cash, and we'll come back to that in a second, or you don't really look at this stock properly or figure out what's going on. I mean, it can be the case that you sold it, but that means there's been something changed significantly about the business that you bought, and that can definitely happen. But I know that I'm going to have to tell Steve sooner or later if I sell something, and he's going to ask why, reasonably enough. And if my reason is a bad one of, well, it went down and I thought it was going to go down some more, I'm going to feel like an idiot telling him. So telling people what you think, hearing what they think, trying to get through things like this together, and when you both are on the same page about how you want to invest, importantly, if that involves kind of staying the course and digging in for the long term, I think talking to someone along the way can really help.
Yeah, agree with that. I think the only caveat that I would add to that is obviously make sure you find yourself a supportive community, but know the difference between a supportive community and an echo chamber, because an echo chamber can just leave you in bad stocks for longer than you need to be. I see a lot of these on the Trading 2-on-2 community. They open up these communities for individual stocks, and the people in there tend to act like cultists rather than like investors, and they don't accept bad words on stocks and things like that. So just keep an eye out on, you know, whether you think what you're in is essentially an echo chamber of people who will only repeat positive news and won't accept any criticism, or whether you're in a community that actually genuinely takes criticism on board, perhaps debates it, but does take that feedback on board. So my hot tip number 3, I suppose, because Steve's done number 2, would be to take the opportunity to reassess your portfolio. Maybe that will involve you de-risking your portfolio. Maybe that will include you having a flight to more quality stocks. So in big crashes, which is not what we're experiencing at the moment, but if there is a big crash, you can get more certainty and still get a good return. You don't need to go looking further down the risk chain for good returns. You'll be able to get that from more staples, companies you've heard of, bigger names. So it's good to keep assessing, just keep in touch with those bigger names through listening to shows like this, for listening to lots of podcasts, people who talk about stocks. Eventually they'll start covering stocks that perhaps you thought were way off the radar, and all of a sudden you'll learn something new about them. But also, if you're up all night worrying about your stocks and your portfolio and the amount that it's going down, you should consider if an all-equity portfolio is actually for you. There's no shame in having bonds or commodities or anything like that to help smooth out volatility. There's no issues with taking a 90-10 portfolio, an 80-20. Some people might be 50-50. So long as you understand, that smoothing out the volatility can affect returns, and you're happy with that, there's certainly no shame in de-risking your portfolio in that way.
Yeah, I think there's nothing the matter with being partly in stocks, partly in bonds. Ultimately, you have to find the portfolio that fits right with you, and that's a function of a couple of things. It's a function of your ability to put up with risk, and to some extent you're born with that, and to some extent you can develop it over time, but that takes time to develop this. More on that in a second with my next point. But I think if you kind of find yourself in a falling stock market and decide that's not really what you want, better late than never when it comes to getting your kind of portfolio allocation right. If you go through a downturn, find yourself in a downturn and think, okay, I'd like to have been a bit more stable through that. Nothing the matter with adjusting into potentially bonds, potentially other things, potentially ETFs, any of that kind of stuff that you would like to be a part of, whether it's commodities or something else. But I think there's an awful lot that comes with learning, and your risk tolerance may shift over time as well, which is worth bearing in mind. So where you started up might not be where you ultimately finish. Maybe you get older and find that you think, well, actually I'm getting closer to retirement, I don't really want a big drawdown here, I'd rather be in something a bit more stable. Or maybe you kind of develop a bit more and become a bit more experienced and think, you know what, I'm okay with this. I should probably be looking to tilt towards some more volatile things, or things I understand better that I previously thought were raging errors. Relatedly, I mean, my second kind of observation is that I think, having seen a few bits of volatile stock market now over the last not that many years, I've lived through plenty, but I haven't been investing through plenty. Over the last sort of 5 years or so, one thing I've noticed is that they're actually much easier to put up with these kind of stock market shifts the more you see them, partly because you've seen them will resolve itself before, but also partly seeing your stocks falling is, I think, a lot easier when you're going from a big green number in your returns thing to a decent sized green number. So actually watching your returns go from 70% up to 40% up is a lot less painful than watching your returns go from flat to down 5% or down 10% or something like that. And that generally comes from sitting in stocks for long enough, because if you invest well and invest smart and find the right stocks to buy at the right prices, or anywhere near the right stocks to buy at the right prices, you will generally find yourself up plenty by the time a big kind of drawdown comes. And it's one thing to kind of think, well, I know it will become easier in the future. And another thing to really feel it. I think it's quite hard to have that kind of empathy. But if you can keep in mind that these things do get easier over time, because I think it's easier seeing yourself going from a losing part of your profits to losing your input capital. It's not a way I love thinking about investing in terms of this kind of house money chat and so on. But I do find there's something psychologically easier about seeing. I've seen Southern Copper go backwards, but I'm already up more than 100% on Southern Copper, and I feel like that barely noticed that, to be honest. Large green number or massive green number becomes large green number. Whereas I've got some other things like Diageo that I'm down about 15% on, and that actually feels kind of different, even if the fall in Southern Copper has actually been bigger than the fall in Diageo in the context of either my portfolio or the stocks themselves. So it's interesting the way these things feel different, even if they are in fact all the same. And generally speaking, that will get easier over time if you can sit in there and stay in there. Steve?
Yeah, it's like being punched in the gut. I think that every time a correction comes along, you get punched in a slightly different position, but at the end of the day, it's still a punch in the gut, and that's kind of how I feel about the corrections. But for anybody who has been punched in the gut, you will also know it doesn't last forever. It is a short term pain, and eventually that disappears, and you forget about it. And that's kind of how I feel about things like this. So when you log in, you see that initial disappearance of funds, and it, like you say, Steve, losing part of your profit feels a lot less worse than feeling losing part of your principal during the 2022 crash, which went on for a long time actually for me, and 2021. I was in quite a lot of small caps in that period as well. So realistically, the crash in small caps started halfway through the year previous. So I got a double whammy of that. Lost all of the profit in my account and about 20,000 of principal at one point. But that soon came back, it gives you a lot of perspective. With how he feels and how it deals with it. And this one feels very similar, Steve, in that there's a lot of negative news out there. There's a lot of punches to the gut, but they don't hurt as much because at the moment I've got that little cushion of green. So look, my final tip would be to just make sure that your house is in order. And I mean this in two ways, really. So it's like take a good look at your portfolio, make sure everyone in there who's it should be there, and you haven't changed your mind about them. The company hasn't changed materially for the worse. You're not just hanging on to something for with hope. You actually believe in the plan and think that that you honestly believe that it will turn around. It's a really good opportunity to get rid of some of these companies that you no longer believe in, because there's a lot of other companies in the same boat that you could potentially switch into. But it's not just that. I would say also focus on your other aspects of your finances as well. So maybe if you haven't built up a sufficient emergency fund, it would be worth focusing on doing something like that. If your mortgage is coming up, then spend a little bit of time thinking about that. Your savings, your mortgages, all other aspects of your finances. Just spend some time learning about that. Perhaps you haven't looked at your pension, your workplace pension in a while. Good time to have a look at that and see if you can swap it somewhere else. But yeah, get your financial house in order, Steve.
I think that's right. I mean, it's very easy to say, look, when share prices go down, the thing to do is buy. But in general, neither you nor I particularly tend to sort of sit with cash waiting for corrections to come. Even if prices are generally quite high, we tend towards looking for opportunities when we have cash and sticking them in the best places we can for whatever the relevant opportunity is at that moment. And maybe it turns out it's going to be lower in a couple of weeks' time. But there's something to be said about the obvious kind of thing to say is go buy stuff while it's cheap. But if it was straightforward as that, you wouldn't worry about corrections. You just say wait till they fall and then buy. And we don't think it's as straightforward as that. I think the point about keeping your house in order is the right one. I mean, ultimately, the thing that will allow you to stay in through a correction and see the better times on the other side of it, because there's only really a disaster long term in a drawdown or a correction is if you get forced out of the market. And that comes if you sell for some reason. And the worst way in which that could happen is if you find you have to sell because you need cash for some specific thing. And in order to do that, the right thing to do is make sure you keep enough back on the sidelines, not so you can go and invest it all, but make sure that your kind of house balance sheet and so on is in pretty good order. I mean, I think one of the best things you can do is try and focus on generating as much cash as you can, and then trying to invest in these situations. But look, if it was as straightforward as make more money, then we wouldn't have kind of financial podcasts, and everyone would just be saying, "Well, make more cash." So we're sort of assuming that your income is what it is, and you're doing reasonably smart things with it. I mean, I take these as an opportunity sometimes, or one of the things I like doing here is making sure that my emergency fund is in the right places. And making sure that, to some extent, a large emergency fund is your guard against having to pay out other things. I have a cheap phone contract, so I don't mess around with insurance. I just use the emergency fund to cover the cost if it comes back, and that way I end up collecting interest and paying it out. So making sure that your house is in order, both in your portfolio, certainly, and taking a look. And sometimes you will find that you want to reassess your thesis, and it feels different when the market disagrees with you, because basically share prices going down is the market's way of saying, no, we don't think it's a buy at that price it was at the previous day, so it goes lower. And it's easy to be comfortable in your view when things people are in agreement with you, and tougher when they're not. But if you can sit in there and think and point to why you think this is a good reason, then convince. It's ultimately you only have to convince yourself, right? I mentioned the thing about talking to other people, but whether that's on X or anywhere else, look, it doesn't really matter if anyone agrees with you or disagrees with you, as long as you're happy in your own view. It's your portfolio and your money at the end of it, Steve.
Yeah, agree with that, Steve. I think it's really about finding ways that you can. It's two things, isn't it? Because you want to, when stocks are down, you want to find a way to get as much money into the market as you can, because there's undoubtedly going to be some opportunities for you that you should exploit. So how you go about that depends on what your skills are. So, Steve, I think me and you both took essentially second jobs during around the last correction. I mean, we probably took third jobs, Steve. This has probably been a job. We've just been forgetting to pay each other. So we've maybe got three jobs going on at the moment. But yeah, depending on your skill set, what can you do to generate more cash? Because at the end of the day, you're going to want to put more cash into the market. I remember this quite famous one of Damien's first videos that he, I think he was buying a buy to let, and he was quite far down the chain, and the stock market collapsed during coronavirus, and he was like, right, cancel that. This is going in the stock market. And I think he had quite a bit of pushback from sort of friends and family. But I mean, look at that move now. It's been a fantastic winner.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.